dear students, welcome to the 8th session on the chapter retirement of a partner. So let us take up the next question in this session. The balance sheet of A, B and C, who were sharing profits and losses in the ratio of 1/2, 1/3 and 1/6 respectively was as follows. On the asset side we find cash in hand, cash at bank, bills receivables, book debts, stock, furniture, plant and machinery and buildings. On the liability side we have bills payable, creditors, profit and loss account, capitals of A, B and C. A retires from the business as on 1st July 2012 and his share in the firm is to be ascertained on the revaluation of assets as follows. Stock is revalued at 20,000, furniture at 3,000, plant and machinery at 9,000, building at 20,000 and rupees 850 is to be provided for doubtful debts. Second one, the goodwill of the firm is to be fixed at 6,000. Then third one, A is to be paid 11,050 in cash on retirement and the balance in equal 3 yearly installment with 5% interest per annum. Show the ledger accounts and balance sheet. So here in this question, again it is given that there were 3 partners and their old profit sharing ratio was 1/2, 1/3 and 1/6. If you see the denominators here, it is not equal. So in order to equate the denominator, we have to take LCM as 6. So we have to multiply 3 to the first part and 2 to the second part. In that case, the old profit sharing ratio will be 3:2:1. Okay, and who has retired here? A has retired. So first person is retiring, and in the question they have not given anything regarding the other information like new profit sharing ratio or any other information is not given. So how do we calculate the gain ratio here? That is for the first working note. As per case 2 we have to calculate. Okay, case 2 says that gain ratio is equal to new profit sharing ratio. In this case, if A retires, who are the remaining partners? B and C, and their new profit sharing ratio will be 2:1 and that itself is the gain ratio. Here the gain ratio is required for making the adjustment of goodwill. In this question we don't find the goodwill in the balance sheet on the asset side, but it is given in the adjustment under the second one. The goodwill of the firm is fixed at 6,000, but we cannot show the goodwill adjustment for 6,000. We have to show only with regard to retiring partner share. So that is 6,000 into 3/6. So only with regard to this we are going to show the goodwill adjustment. So let's see those 2 working notes now. Calculation of gain ratio as per case 2. Gain ratio is equal to new profit sharing ratio, which is equal to 2:1. Total goodwill of the firm is 6,000. 6,000 into 3/6. Retiring partner share comes to 3,000, and this should be distributed between B and C in the gain ratio of 2:1. The adjustment entry for goodwill is remaining partners capital account data to retiring partners capital account. B's capital account data 3,000 into 2/3, 2,000. Then C's capital account data 3,000 into 1/3, 1,000. 2A's capital account. So this is the goodwill adjustment entry. Then here it is given that show necessary ledger account and balance sheet, and in this case we don't find any sentence like the values of assets and liabilities should not be altered or it should be shown at its original value, nothing like that. So which means that in this case we are going to prepare the revaluation account. So let us consider what are the adjustments that should be considered in the revaluation account. So here it is given that these are the revalued figure of various assets. We have to compare it with the book value. So and we have to see whether there is decrease in the value of asset or increase in the value of asset. Coming to stock, they have given here book value of how much? 22,300, and now it is revalued at how much? 20,000. So there is decrease in the value of stock, which should be shown on the debit side of the revaluation account. Then coming to furniture, the book value is 3,500. The revalued figure is 3,000. So again there is decrease in the value of furniture, which is to be debited to the revaluation account. Plant and machinery, the book value was 9,750. Then in the revalued figure it is given at 9,000. So here there is again decrease in the value of furniture, so it should be taken in the revaluation account. Then coming to buildings, it is 24,000. Book value is given at 24,000, but here they have given only 20,000. Again there is decrease in the value of building, which should be taken to the revaluation account on the debit side. And one more adjustment given as rupees 850 is to be provided for doubtful debts. If you check the asset side of the balance sheet, they have given book debts or debtors to the extent of 17,800, but we don't find any old provision, so we have to now provide for the doubtful debts, and you are creating a provision against doubtful debt, that is against an asset which is a revaluation loss. So all these losses have to be shown in the revaluation account, and we have to find out whether there is net profit or net loss. 2 stock for the reduction in the value of stock, 2 furniture, 2 plant and machinery, 2 RBD and 2 buildings. So all are the revaluation losses itself. There is no even single revaluation profit. So when you close the revaluation account, debit side total is more, which is 8,400. We get the same balancing figure here, and this represents net loss on revaluation, which should be transferred to all partners capital account in the old profit sharing ratio, that is 3:2:1. A will get 4,200, B will get 2,800 and C will get 1,400. So then we are going to prepare the partners capital account. As usual, first we need to write the opening capital balances as given in the question: 40,000, 25,000 and 20,000. The next step is to transfer the reserve, but in this case they have not given reserve. We don't find any reserve on the liability side. The next step is to check if there is any profit and loss account debit or credit balance. Here they have given on the credit side or the liability side, which represent profit. Okay, credit balance represent profit, and this should be transferred to all partners capital account in the old profit sharing ratio. So in the capital account you have to write by profit and loss account in the 3:2:1 ratio you have to distribute. After this we have to transfer the revaluation loss. In this case we have revaluation loss, and the entry we have passed was all partners capital account data to revaluation account. So you have to write the entry here in the debit side to revaluation account. Then we have to show the goodwill adjustment entry. So we have to record both the sides of transaction. By B's capital account, by C's capital account, amount should be written in A's column. Then to A's capital account, amount should be written in B and C's column. So by B's capital account, by C's capital account, we have written the amount in A's column. Then to A's capital account, the amount has been written in B and C's column. After this, we are going to close the capital account of the partners one by one. First, let's close the retiring partners capital account. So if you see here, the total credit comes to 45,250. Same total is written here. If you deduct this revaluation loss, there will be balance of 41,050. Out of which it is stated in the question that 11,050 has to be paid in cash on retirement, and the balance in 3 equal yearly installment with 5% per annum, 5% interest per annum. So now the balance remaining is, total balance available in the capital account is 41,050. So you have to pay now how much? 11,050. What will be the remaining balance then? 30,000, and this 30,000 has to be paid to him in next 3 years with equal yearly installment at 5% rate of interest. So divided by 3. So annually he should be paid interest of he should be paid installment of 10,000 here. Okay, then he is paid 11,050. Let's pass the entry for that to bank account 11,050, and the remaining balance, since it is paid in another 3 years in equal yearly installment, now it has to be transferred to his loan account. So you have to write to A's loan account, final balance transferred 30,000. Then later we are going to close the other partners capital account also. It comes to 26,500 and 20,000. 750. The same total is written here. You take the balancing figure, which comes to 21,700 and 18,350. So these are going to be the closing capital balances. Okay, then we are going to prepare the bank account, because the amount has been paid to the partner at the time of retirement. So the opening bank balance is 25,500. So we have paid to A on his retirement. What is the entry we have passed here? A's capital account data to bank account. So in the bank account we have to write by A's capital account, amount paid on retirement 11,050. So the remaining or the closing bank balance, this is the balancing figure. So closing bank balance would be 14,450. Then let's see how to prepare the balance sheet. So while preparing the balance sheet here, please remember here we have not prepared a memorandum revaluation account. So all the assets and liabilities have to appear at their revalued figure. The first one, cash in hand, there is no adjustment, as it is we are writing. Cash at bank, we have to write the closing closing bank balance, as we just now calculated, 14,450. Bills receivable, there is no adjustment, we are writing as it is. Datas, we have to take 17,800 was the book value. From that we have to deduct the provision which is created, 850. The remaining balance would be 16,950. Okay, I have not shown here in the bracket all those calculations, but you have to show it. Okay, then stock account, here also it was book value was 22,300 minus 20,000, which comes to 20,000. Furniture also 3,500 minus 500, 3,000. Plant and machinery 9,750 minus 750, it comes to 9,000. Buildings 24,000 minus 4,000, which comes to 20,000. So these are the various assets. On the liability side, bills payable, as it is we have to write. Creditors also. Before writing the capitals of remaining partners, there is a loan which is advanced by A at the time of his retirement, amounting to 30,000. Okay, and then we are going to write the closing capital balances of B and C. So here the balance sheet would tally at 88,950. So usually we prepare all these ledger accounts, but in this question it is stated that the remaining balance which has been transferred to A's loan account has to be repaid to him in 3 yearly installment with 5% rate of interest. So let us prepare A's loan account to show how it has to be discharged in the 3 years. Okay, so A's loan account, so on which date he has retired? 1/7/2012. Okay, this balance comes from here. So here what is the entry you have written while transferring this 30,000? A's capital account. From the capital account you have transferred it to his loan account. So in the loan account you have to write by A's capital account as on 1/7/2012, 30,000. Okay, then it is stated that we have to pay this 30,000 in 3 yearly installment. Okay, at the end of first year you will be paying the first installment, that is 10,000. Then at the end of second year you will be again paying 10,000. At the end of the third year you will be paying 10,000. But while paying this 10,000 you have to also add the interest at 5% on the outstanding balance. So now the date on which the amount has been transferred to loan account is on 1/7/2012. When that 1 year gets completed, it is on 30th/6/2013. Okay, that is 30th June 2013. Before paying the installment, we have to charge the interest on the outstanding amount, not on installment. Please remember, the interest has to be charged on the outstanding amount. What is the outstanding amount here? 30,000. We have not yet paid anything. So on 30,000 we have to charge 5%, which comes to 1,500. We have to credit that here by interest account 1,500. Then for making the first installment payment on 30th/6/2013 to bank account, so you have to add the interest to the installment of 10,000. So what is the amount you are going to pay? 11,500. After this you are going to close the account for the first year. You will have balance of the 2 installment, that is 20,000 on 30th/6/2013. Very next day, that is on 1/7/2013, we are going to bring down this balance, that is 20,000. Again you have to see when that 1 year gets completed. It is on 30th/6/2014. Again we have to charge the interest on the outstanding balance. So what is the outstanding balance now? 20,000. On that 5%, which comes to 1,000. On that date you have to make the second installment payment to bank account, 10,000 plus interest of 1,000, which comes to 11,000. After this we are going to close the account for the second year. So we will have a balance of now only 10,000. Okay, again this will be taken to the beginning of next year, that is very next day, 1/7/2014. So by balance brought down. Again you have to see when that third year gets completed. On 30th/6/2015 we have to charge the interest on the outstanding balance, that is 10,000. It comes to 500. Then for the last installment payment to bank account, 10,000 plus 500, which comes to 10,500. Here this loan account will be completely paid off. So this is how you have to prepare A's loan account if it is required and if it is asked in the question. So this is the solution for the present question. So let us take a few more questions in the upcoming videos. Thank you for watching.